Good evening, everyone. Thank you for joining us this evening in our session to further discuss taxes as promised. Before we go any further, I would like us to have a word of prayer. Dear Heavenly Father, I come to you this evening and to say thank you for the gift of life. Thank you for the opportunity to be here and even just the grace to be able to teach your children and to walk this journey with them. Be with us as we begin and even till the end. Guide and protect us. In Jesus' name I pray, trusting and believing. Amen. I would like to thank you. Thank you for joining us in our session today. Before I continue, I'd like to introduce the person seated on my left. Her name is Emily Wang. No, her name is Winnie Wangoi. Sorry, her name is Winnie. She was with me the other time we were doing the first tax session, and it was great, and we saw this as an opportunity to teach people more. Yeah, so you can say hi to everyone.
Good evening, everyone. It's a pleasure to be here and to interact with you all through this 1 hour live session. I hope we'll have an interactive session. As Karen has said, my name is Winnie Wangoi Karuga, tax partner at the firm of Mark and Partners Advocates. With experience in tax and legal matters, and today's webinar is going to be about property taxes, and let Karen start us off.
Yeah. Before we go any further, on Saturday, the 27th of August, we had our grand opening for Skywalk, a project that has been with us for 24 months. It has been a really great journey to work with each and every investor who's taken part in Skywalk, and now I think it's now time for you to get the reality of earning while you sleep as you start getting your rental income. So we are very grateful for everyone who showed up, both online and physically, for the event. Seeing the smiles on your faces was amazing, and it showed us that there's actually something we're doing and we're part of a great purpose. And Skywalk is also out for letting now. So in case you're a young person watching us this evening, I would like to welcome you to come and view the property, get yourself a house within Skywalk and become a Savorite. Yeah. So yes, and also during the grand opening, we also did a launch of our new product, that's Just Divide, which was really, really great, an opportunity for everyone to just come in and join the day. It's property taxes in Kenya. I think because we do real estate, we build apartments, we manage, we sell and design those apartments. Just because we do that, and of course the people we are speaking to are investors within real estate. So it means property taxes are a thing that actually affects them. So I think for property taxes, this include income tax, the monthly rental income tax, which is, I think, common with everyone, the capital gains tax, stamp duty, and value-added tax. So I think, property taxes are divided into two. That's commercial and residential, because you can put up a property and have people live in it, or put up a property and have businesses residing in it, or have businesses running within the building. So I think that's what we are discussing today. So we've narrowed it down to what affects you as a real estate investor, what affects you as someone in the property business. So I think we can first take it up with residential MRI, and maybe you can give us a bit of background and pointers. Yes, as our expert.
Thanks, Karen, for that introduction. And maybe just before I start, it's been a great honor to just watch Savo grow in the last 7 years, and witnessing the grand opening of Skywalk on Saturday was just really amazing. You guys did a great job. I have to commend you for that.
Thank you.
The setup was beautiful. The structure, I mean, is what you see is what you get from the brochures that we saw for Skywalk. That you are able to deliver the dream promise.
Thank you.
Savo team, well done. So back to taxes. The earlier webinar that we had on taxes just sort of laid the foundation. We were discussing the changes made by the Finance Act, but before we started, we sort of laid a foundation of the taxes that are applicable to businesses and individuals in Kenya. And we saw it fit that to further just scale this discussion up, we now do sector-specific taxes, and we decided to start with real estate because this is a real estate company, and most of the investors are buying properties or selling properties, or they have land. Real estate is a very emotive and very passionate discussion in Kenya generally. So we felt that maybe most people are not aware of the taxes applicable, and this would be a good series to just run through. And as Karen has said, there are various taxes that apply to real estate. So the income tax, which has further some categories within income tax, and then we have VAT that applies on commercial property, and then we have your stamp duty, which is tax payable to the Ministry of Lands but collected as an agency revenue by the Kenya Revenue Authority. And then we have capital gains tax. So in a nutshell, those are the typical taxes that would apply on real estate and property. And we have further split this into whether the property is commercial or the property is residential. And we'll start off with residential because that's what applies to most of our target audience here.
Yeah.
And for residential, the tax that's applicable is what we call the monthly rental income tax. And I'm sure most of you have heard about it now. So it's not a fairly new tax that you are hearing for the first time. And the tax was introduced through the Finance Act of 2015, and it came into force from 1st of January 2016. And really the genesis of this act was, the genesis of this tax was to just try and bring residential landlord or residential property owners into the ambit of tax, because the law was clear of how commercial property is taxed, and in most instances commercial property was owned by businesses, so they'll account for it through your normal corporate tax regime, but it wasn't clear on how residential is taxed, and so a very simplified regime for residential rental property was introduced back in 2016. So we've had a bit of changes from then to date of how this works, and the key change has just been who does it apply to, and what is the threshold, what is the minimum residential rental income that you must have for you to fall into that bracket. And so how the tax is administered is that it's chargeable on any income earned from residential property by a resident person. And I'll break it down further. So the Act says that it's payable by a resident person, and it's good to just understand who is a resident person. And the term resident is a strictly defined term under the Income Tax Act. And there are certain criteria that you have to meet for you to determine whether you're a resident or non-resident. So this effectively means that any person who meets the conditions of being a tax resident in Kenya and has residential rental income falls under MRI. And the question would come about, what about people who are non-resident? Yeah. What about diaspora investors? Yeah, I mean, Tsavo is global. Last month they were in the UK, and I'm sure you got clients who will buy into Tsavo. Yeah. So what happens to people who reside abroad but still invest back home? So the regime that works is, if you are a resident person, we'll first have to look at the criteria of whether you have met what the Act considers resident for tax purposes. And resident is not just because you reside in Kenya. There are certain things that have to be met, and these are defined to include whether you have a permanent home in Kenya. And a permanent home is a place that is available to you at any given time. So even if you stay abroad and you have a home that you had built here back then, and now probably your relatives stay in that home, then automatically, despite living abroad, you have a permanent home somewhere that is open and available and accessible to you when you're back in the country. So despite working and staying abroad, you are a tax resident in Kenya. The second test is whether you have been in Kenya for at least 6 months or 183 days in that year of income. So if you have been in Kenya for those number of days, then automatically, if you invest with Tsavo and you live abroad, you are a tax resident in that regard. The further test, if say you haven't met the first one, the second one, we go into, for the last 2 years, have you been in Kenya for at least 122 days? So you will see, as we're discussing this varies according to a personal and an individual's unique circumstances. So it's not just by the mere fact that you live and work abroad, you become non-resident. You could be non-resident by the fact that maybe you live and work abroad, but you're in Kenya for a maximum of 6 months every year. So automatically, you are subject to our taxation regime as a resident person in Kenya. And therefore, if you are a diaspora investor and you have a home, then if you have met the resident rules, you are supposed to pay MRI. So that's the distinction. And recently, in the Finance Act of 2022, in an effort to just further clarify who is a resident person or who is a person with a permanent establishment in Kenya, it was further expanded to mean that despite having a permanent home and meeting those number of days test, if you have key economic interests in this country, then the commissioner can deem that you are resident. So with that kind of language, then key economic interest really could be you have 5-10 apartments, or you still own land in Kenya, or you have a passive business here in Kenya. So in as much as you reside and work abroad, you still have economic interest in Kenya. And that way you can be deemed as a resident. So while we are saying that MRI strictly applies to resident persons, and resident persons is either an individual or a corporate entity, and for non-resident, the regime is different. The regime is a withholding tax regime where the tenant is charged with an obligation to withhold tax and pay you net of withholding tax. So for any premises, so either leased or rented by a non-resident person here in Kenya, then the applicable regime for properties owned by a non-resident person is usually withholding tax. So before, say, a diaspora investor or any person who considers themselves resident or non-resident makes that call that you are actually fall within MRI or you don't fall within MRI because you consider yourself a non-resident, it will just be critical to assess your personal circumstances to see whether you have met the conditions or not. So basically that's the background, and then we can go into now how is it administered.
So okay, you've talked about thresholds. Maybe you'd want to mention what's the minimum, what's the maximum, and also when is it payable.
Okay. So to the administration of this tax, the Act provided that any income, if you're earning residential income, that is between 288,000 per annum to 15 million per annum, then you fall into the MRI. So because the rates are given per annum and rent is collected either monthly or quarterly, then you have to assess what's the monthly rate. So we'll use the lower threshold of 288,000 to see what is the monthly threshold for me to determine is the little rent that I earn from this studio of mine subject to MRI. And if you divide 288,000 by 12, it's 24,000. So effectively that means anything above 24,000 per month falls under MRI. So between 24,000 a month to 15 million a year. So if you have 3 one-bedrooms that give you between 20,000, so probably if a one-bedroom goes for 20,000, so that's 60,000, then automatically you have exceeded the monthly threshold. Or if we sum up your annual income, it will be more than 288,000. Then you should fall within MRI. And MRI is computed on a very straightforward and simplified basis. It's usually 10% of your gross rental income. So if your gross rental income is, say, that 20,000, it will be 10% of 20,000. So I'll give an example. Savo here does agency services. you manage the units
Yes, we
on
manage
behalf
the
of the tenants,
Yeah.
and you of the land of
yeah.
the property
Yeah.
owners, and you charge the property owner something.
Yes.
So which would be to make sure that the room has a tenant. If there are any repairs, it's your work.
Yes.
So that you lift that burden for having investors being called by tenants all the time, right?
Yes, yes.
And you charge an agency fee for that.
Yes.
Yes. So assuming the agency fee is what?
It's 8%, so maybe for a studio would be 880.
So assuming the agency fee is 880, and your gross rental is say 15,000, so the MRI will be on the 15,000 and not 15,000 less 880.
Okay.
So ideally for MRI, you are not allowed to deduct expenses. It is very simplified. It is 10% of your gross revenue, which is paid monthly. So, and how it works is you log on to iTax. So I'm sure every investor has a PIN, a KRA PIN.
Yes.
So you log on to your KRA PIN. On iTax, you go to the tab written payments, you choose, and you say it will give you whatever you want to pay for. And then you choose. If you say income tax rental, it will give you a drop-down menu for how to account for MRI. Okay. So it is very straightforward, and it's 10% of gross. So just to emphasize that even if there are certain agency costs or even utilities, so there is a service fee here and there, electricity, water here and there, you don't deduct that from MRI. So MRI is the gross rent that you charge your tenants.
Okay.
Yeah.
Maybe to just further ask, do I have a choice? Can I choose to be within the regime or outside?
Okay, interesting question. So by default, to the extent that you fall within the threshold, it is required that you fall within MRI, and you go that simplified 10% route. However, the commissioner, the KRA, provides for an opportunity where you can elect not to fall under that regime. So if you elect based on your circumstances, say probably you have very high expenses and you feel if you do the 10% MRI route, which is expected that your profit, actually the way 10% was arrived, is it's expected that your gross profit from your returns from your rent will be around 10%. So if you feel that if you go, if you don't do the gross income route, which is the MRI route, and you take the other route, which we'll discuss shortly, where you're going to net off your expenses for one reason or the other. So I'll give an example of, say, you have a huge loan. So you took up a loan facility to develop a residential unit, and you're paying some significant interest expense. Because if you do the MRI route, even if your rental yield is within the 15 million threshold, you can't deduct your interest expense. But if you take advantage of interest, which is an allowable expense, and you deduct that from your gross rental, then probably that way it will work for you, or you have many number of units. So instead of just administratively saying the number of units times the 10 times the rate, you elect to go the another regime where you can do a net basis. So you take your gross rent, you deduct your expenses, you can approach the commissioner for that. So you write a letter to the commissioner explaining your circumstances and explaining why you would like to opt out from MRI. And if it's approved, then you don't need to account for MRI. And remember, when you're doing MRI, you don't do the other regime. So they work mutually exclusively. Yeah.
Okay. Maybe what are the merits? I think as you're explaining, we can see the administration of the tax is a bit more easier. It does not need you to have a lot of accounting in your head for you to calculate this. But what are those merits for you to do MRI?
Okay. Yeah. So when iTax was introduced, of course, all of us panicked. We are not used to technology, and you have to log in and have internet, and it's an interface, you have to familiarize yourself. So it was very difficult to administer tax, and part of the way to increase the tax base is to make it simple. Like it has to be simple and easily understood by the by the public. So part of what, just to make MRI attractive, is that it was designed as a very simplified regime. So simplified in the sense of you don't need to keep records. No one will come and ask you, show me your books of accounts, show me your expenses, show me your balance sheet and your trial balance for MRI. No, you don't need to keep all those records. You just need to know you have X number of units. For each number of units, this is the rent. And then you put the amount and it automatically computes for you at 10%.
Yeah.
So it is very simplified to the extent that it does not have administrative burden with it. So if you are a landowner or a property owner and you have rental units, you really don't need to hire an accountant to do for MRI.
Yeah.
But of course, not very many people are conversant with iTax, and you have to do it the right way. So if you're not able to do it, we provide those services. You can reach out to Tsavo or myself, and we will help you with that. But the system and the regime is very simplified. So that's one of the advantages. The second advantage is instead of you keeping a record of all your expenses and trying to justify whether these expenses are allowable, because for a business, there are certain expenses that are allowed by the law, and there are certain that are not allowed. Yeah, so for instance, any personal expense is not allowed. Capital item expenses are not allowed. So if you are paying what? So if we go back to the loan example, only the interest charge is allowed and not the principal. So because not very many people know what is allowed and what is not allowed, it is a very simplified regime of gross times 10%.
Times 10%.
So very straightforward. And the third reason is the fact that it's monthly and it's a final tax. So unlike say PYE, where your employer has to deduct PYE every month, and then at the end of the year you have to go to your iTax to reconcile and say my employer deducted X PYE, iTax computes based on my taxable income, employment income is Y PYE, is there a difference I need to pay, is there insurance relief or mortgage relief I need to take? So unlike the other taxes where there's always an additional thing, MRI is one-off and final. So if you pay MRI for say August, by 20th September, that is it. Come December or June of next year, there'll be no filing of another return in regards to MRI for last year or last month.
Okay.
Yeah.
Okay. What if I don't have a tenant? What happens?
Okay. Interesting question. So, so again, how MRI works is, as I mentioned, it's very simplified, and you don't need to apply to KRA to register you. So unlike all the other taxes, say VAT or PAYE, that you have to apply to KRA for registration as and when the obligation materializes, MRI doesn't have that. So it is more or less, it works more or less like withholding tax. So withholding tax is not a tax obligation, it's a payment obligation. So when everyone on their PIN, they can pay for MRI. Yeah, so if you go to your PIN and you go to returns, if you select return, you choose income tax rental, it will give you an MRI return. And how it works practically is the moment you initiate your first MRI payment, say I'm a landowner, I'm a unit owner at Skywalk, this month I get a tenant, next month I'm due for MRI. So if I go to my iTax and I want to pay that MRI, I will click and say I have 2 units, probably the units give me 20,000 each, so that's 40,000, 10% 4,000, and then you click submit. So it will give you a PRN to pay. But what happens in the back system is the moment you initiate your first MRI payment, automatically the system registers you for MRI. So it's like KRA is aware, now you have a unit and now you have a tenant, we expect you to pay MRI on it. So automatically, the moment you initiate your first MRI return, you're registered for MRI. And back to your question, what happens in the months I don't have a tenant? Because it's a normal business occurrence. You have a tenant this month, next month, for one reason or the other you don't. So if you don't have a tenant in the next month, remember you now have an obligation because automatically the system registered you. So if you don't have a tenant, you're supposed to go back to return and file nil. Yeah, if you don't file a nil MRI return where you don't have a tenant, then it will trigger a penalty on your system.
Okay.
So for anyone who's ever filed MRI and you have not been filing, if you go to your PIN and look at the ledgers, you are likely to find a penalty for not filing. Yeah.
Speaking of penalties, just apart from the penalty for late filing, maybe you can clarify what is it exactly in terms of quantities or percentages for individuals and for corporates, and then now we can go to the other penalties for late payment, which basically are consequences of you not honoring your tax obligation.
Yeah. So so there are two types of penalties. So so if it's your obligation, there will be a consequence, and the consequence would be a penalty. So the penalties are in two folds. So the first penalty is usually if the tax obligation has a filing requirement, then there will be a late filing penalty. So talking of which, the deadline for MRI is usually the 20th of the following month. So if today is 31st of August, so investors would usually get their rent by
The
10th,
relating
relating to last month, right?
No,
Oh.
it would be the rent for
For
that, month. Yeah.
So the rent that you receive on the 10th for that month, you need to pay the MRI 20th of the following month,
Okay.
the 20th day of the following month.
Okay.
So if come the 20th and you have a tenant and you fail to pay, or if you don't have a tenant, you fail to declare that you don't have a tenant, like nil, then the penalties are late filing, because remember you have to file that MRI return for you to generate the payment slip. So if the late filing would usually be, for individuals, it's 2,000 per month, and for corporates, it's usually 20,000 per month. And if and so how it works, it's usually the fixed amount or the higher of. So if the higher of, in this instance, it will be 5% of the tax that is due. So if your MRI that was due was supposed to be, say, 10,000, 5% would be 500. Yeah. So if 500, of course, is lower than 2,000, then the penalty becomes 2,000.
Okay.
Yeah. So that's penalty number one. Penalty number two is usually late payment. So if, say, you generate the e-slip for MRI by the 20th, and then, or you forget, and 21st it hits you, I have not paid MRI. So you go and generate. So again, it's usually, there'll be a late payment penalty, which is 5% of the MRI that is due. And for as long as you haven't paid the principal tax, interest begins to accrue. And the interest is usually 1% of the tax due. And you'll probably say, it's okay, I'll have a penalty, but so what? Yeah, KRA doesn't know why it's stay, KRA can't come and enforce. In future, if you want to get a tax compliance certificate, for whatever reason, you want to get a tender, or you want to be a board of a company and they ask you for a tax compliance certificate, then you can't get it until you have resolved all those penalties in your ledgers. Yeah.
Okay. I think we're doing good. Maybe we can very quickly move into commercial rental income. I think the same. Maybe you can give us a bit of background. What's the rate? What's the period? Is it the same as what we do for MRI? And then what's the basis it's accounted for?
Okay.
So is it on gross or net? Yeah.
Okay. So so commercial rental income applies to commercial buildings. So you own a commercial property and you're earning commercial rent. And commercial rent would be anything that is not residential.
Yes,
so to speak,
yes.
using the same term to define it. So anything that is not residential. So if you have a commercial building that you have leased out as an office space, that is a commercial building. If you have a commercial building or space that you have leased out to shops or stalls, that's a commercial building. So anything that is not residential. And unlike the Income Tax Act, the VAT Act has tried to further even distinguish what is commercial and what is residential. And they give an example of residential would be anything that is leased for rental spaces, is leased for residential purposes. And they even go ahead to give like the number of months. So if you lease space for at least more than a month for residential purposes, then that's residential. And what the VAT Act tried to do, because commercial buildings or commercial property are subject to VAT, which is another tax we will cover. So what the VAT Act tried to do is to even narrow down to distinguish this very dynamic type of spaces that you're not sure whether it's a commercial space or a residential space. And I'll give you an example of serviced apartments, holiday homes, holiday cottages, safari camps, game lodges. So in as much as they are for residential purpose, like you go to a safari camp or a game lodge or a furnished apartment for residential, the VAT Act made a distinction that that is not residential. So that is considered commercial and it attracts VAT. So if we are to borrow the same kind of interpretation, then anything that is not really residential where you reside and for a long term where you have a lease with your landlord that is more than a month, and most leases are usually a year, renewable every year if it's residential, then it falls under commercial. And the tax regime for commercial is different. The commercial regime now, we no longer talk about MRI. That doesn't work for commercial. For commercial, you account for it as any other business income. So how we account for business income is the income you have earned or accrued from Kenya, and then you deduct allowable expenses subject to the Commissioner's interpretation of what is allowable. And then the net is what is subject to tax. So if you're an individual, Karen here has units that are listed out as commercial. So you have stalls. You have these new modern generation stalls where people can put up shops. So that's commercial, but you own it as Karen. You have not incorporated an entity. Then you will take your gross rental, you deduct your expenses which are allowable. We'll discuss what those expenses that are allowable look like, and then you subject it to tax. And since you're an individual, the tax would be based on your graduated PAYE bands. So individuals are not taxed at a flat 30. So individuals are taxed at the graduated PAYE bands. So it sort of gives you a relief from just hitting you 30 at the 100%. So the 10, 25, and then the 30. And then if you're a company, then it will be the same basics. This is a business income. You take your gross rental, you deduct your expenses, and then you subject it to 30% as income. Okay. So you've talked about expenses can be allowable and others non-allowable. I think someone is asking themselves, so what is allowable and what is non-allowable? How do you, like how would you differentiate? So it's a whole tax process to determine what is allowable and what is not allowable. And that's why we say if you're running a business, then it's good to seek tax advice, because you could consider that this is a normal business expense, you deduct it from your gross rental income, but the Act does not provide that you deduct that. So if KRA comes back, they will just remove it and tax you on the difference. So allowable expenses are what we call expenses that have been wholly and exclusively incurred for business. So that is the first rule of thumb. So it has to be a purely business expense, and it goes further to say wholly and exclusively incurred in generating that income. Yes. So it could be that it was wholly and exclusively incurred for business, but you have a separate business where you do trading. And in trading, you have raw materials that you purchase, you have transport costs that you purchase, that you incur. So you can't take your transport costs and bring them to your commercial rent business, because that expense, while it is allowed for business, it wasn't incurred in earning this income. You get? So rule of thumb, before we go into the details of what are these expenses, is that that expense has to be wholly and exclusively incurred in earning that income. And then now we look at other revenue expenses. So we have your revenue expenses and your capital expenses. Your revenue expenses are your day-to-day business your day-to-day business expenses. So these are your repair and maintenance, your utilities, your agency. So really what is day-to-day. So that is allowed. But then now any expense that is of a capital nature is not allowed. So capital nature would be because I have agents that need to go and market my commercial building, I buy a car. It's an expense that has been incurred by this commercial rental business because my agents need to go and market and see my various properties, but it's a capital expense. That car is not allowed. And then because that car is not allowed, any other expense that comes with that car should not be allowed. So capital expenses are usually not allowed, and this would also stretch to say legal fees that are incidental to capital expenses. So I'm acquiring a capital item like the land or the building, and then I incur legal fees. So such capital expense related would not be allowed. And then of course now anything else that is not for business is not allowed. So the list of what is allowed is probably longer than the list of what is not allowed. But rule of thumb is whatever is related to business is allowed. Anything outside earning or accruing that income is not allowed. And then capital expenses and capital losses are not allowed.
That's wonderful. I think one thing about rental income, I think there's a question here that someone is asking. Should you file MRI for a commercial building not in use? Like when should you start filing? I think you've answered that because you've just said for commercial spaces you do it's not MRI.
It's not MRI.
It's done at the very end of the year. So if within the year, maybe in 2 months, there was no one in that commercial space, and then you didn't have income in that building. I think that's very, very eye-opening. Junior is asking, does commercial class include homestay ventures and Airbnb? I think you've also answered that by just stating what the act actually says. Because yes, it's a space that's residential, but it's been used for commercial purposes. You're making money out of it.
So, and maybe just to emphasize, on that issue for Airbnb or even people who take up stalls in a residential building. So most of your buildings have, say, shops on ground floor, shops on first floor. So as a unit owner, I could say I'm buying a shop. You see, it's located in a residential building, but its use is not residential. So that's the distinction. So in as much as even Airbnb is that example. So Airbnb is residential, yes, because someone comes in and stays and lives there, but you're using it for commercial. And the distinction here would be, is the lease more than a month? And in most cases, the Airbnb leases are not even a month or a week. If someone comes and leases space for more than a month, then it purely becomes residential, where you and I stay. But if it's short stays, serviced apartments, that is business. That is business income. So it ceases to be MRI. It becomes commercial space that is subject to income on a, the way you compute income for commercial property.
Okay. I think because there are no further questions on MRI, we can just touch on stamp duty and discuss a few things, because stamp duty is another major task when you talk about property taxes. So it would be good for people to just know what is it, what are the rates, like we hear stamp duty all around when you're buying an apartment, but what really is it?
So maybe just before I touch on stamp duty, another thing I'd like to bring to your attention on the commercial property side is, number one, how to account for it, and what else can be claimed. So So commercial property, when we said you account for it on a net basis. So that's what you need to remember. The distinction between MRI and commercial rent is MRI is gross and it's monthly, and commercial is net. So you take from when you started earning this income, and then you deduct expenses. And we have discussed what expenses are allowed, what are not. So in a more advanced manner, there are certain expenses that commercial buildings would have, and this is what we call capital allowances. So capital allowances are a relief, so to speak, that the government has given you for investing in a certain sector. So say if you build a commercial building, then you are given a deduction or a relief, what we call capital allowance or capital deductions. So from your cost of project, from your cost of construction, from when the building first becomes into use, then you can deduct a percentage. And currently the percentage is 50% in year one, and then 25% for the remaining years. So if your building was, say, for argument's sake, 50 million, and the building is put into use this year, when you're doing your tax computation next year, then you're allowed to deduct 50% of that cost, and as an allowable expense. So if your total revenue, and maybe in most instances, in year one probably you won't have a lot of revenue, but you'll have a lot of expenses because the building takes time to be occupied. So you'll find that what that does to a business is, because of that capital deduction, it puts the business in a loss position, because your income will be probably lower than what you're deducting as expense. So you have a lot of expenses in year one. You are doing marketing, you're doing, I don't know, agency fees, and you're doing insurance and all those things. And then now I come and give you 50% of your 50 million, which is 25 million. So if you don't make income of 25 million that year, then automatically it puts you in a loss position. So that's again another main difference between what we'd call MRI and commercial property. So with commercial property, you have access to capital deductions, and capital deductions here would be your cost of development, where you get the commercial building allowance, and other loose things, say where you get wear and tear. So if you put CCTV cameras, and those CCTV cameras should qualify for capital deduction, you will get at 10% of the cost of those cameras. So and very many other things. So if you put like you buy TVs, I don't know, for whatever reason, and you mount them somewhere in that commercial building, things like lifts. So they allow you to deduct those expenses when you start operating. And because of that, it could easily put you in a loss position, where you are not paying taxes for at least 2 or 3 years before you start paying tax, when now you become profitable. So that's one example. And another thing that I just wanted to mention is for commercial building, if it's a company, then you account for it the company manner through installment taxes. So you pay the taxes through installments, and then at the end of the year, you will do either your tax computation and see did I overpay or underpay, and then it will put you in an overpayment depending with whatever happened that year. So in a nutshell, that's how we account for commercial property. While we are covering VAT, we are going to discuss how VAT sits with commercial property, but that we can do in the next webinar, because there are certain nuances here and there that you have to be clear about, on what is commercial for VAT purposes and what is not, and how do you account for VAT, and what is the threshold for VAT. So commercial, just to know on top of your head, commercial property is subject to VAT, and then when we cover VAT, we will discuss how VAT works. So maybe in the interest of time, we can go into stamp duty, because that is not very complex. And most of you are aware of stamp duty. I'm sure when the development is almost over, when it's over and you need to register the title, you'll be told there's a cost called stamp duty. So just to speak on how stamp duty works is, It's a revenue. It's a form of revenue for the government, and stamp duty essentially goes to the Ministry of Lands as their revenue, collected the same way rent and rents are collected, but it's administered by the KRA. So KRA, on behalf of the Ministry of Land, administers stamp duty as an agency tax. So they collect it on behalf of the ministry. And stamp duty for property, because stamp duty again works in twofold. So there's stamp duty on property, which is real estate property, and stamp duty in shares. So for the purpose of this webinar, we're talking about property, so we'll limit it to stamp duty on property. So stamp duty is applicable on acquisition or transfer of property, and it's payable by the purchaser.
Okay.
So that's a key distinction, that whoever is buying is the one that pays stamp duty. And then capital gains tax is whoever is selling, because the person selling is the one who will make the gain. So for stamp duty, it's payable by the purchaser. Again, for real estate, it's very straightforward. It's usually just based on percentage of what has been assessed by the government valuer. So for stamp duty, you don't assess, it's not a self-assessment regime where you assess yourself and say, this is my basis for stamp duty. It has to go through valuation by licensed government valuers. And once a value has been ascertained, then the next thing would be, what is the rate? So we know this property has been valued, and the property is valued based on different valuation matrices. Where is it located? What is the rental yield? So most valuers would actually visit site to see and to verify and give you a government value of that property. So upon valuation, then the next thing would be what is the rate? What is the tax base for this stamp duty? And it's usually 4% or 2%.
Okay.
So the higher rate of 4% is applicable on zones that have been gazetted as a municipality. So the government gazettes certain zones within a city or now within a county as a municipal area. So such zones would be considered a municipality, and the stamp duty is higher. It's at 4% of whatever has been assessed by the government valuer. And then the 2%, which is the lower rate, applies to non-municipalities, so areas that fall outside a gazetted or a zoned municipality, or what previously were mostly considered agricultural land. So agricultural land is anything that is provided as agricultural land, either in the title or even in terms of zoning. And you'd find even a county as big as Kiambu. There are areas in Kiambu where it's 4% because it's within a municipality, and there are areas in Kiambu where it's 2%. So again, for stamp duty, it's good to seek legal advice so that you get, proper and correct sound advice, so that the valuation is done correctly, the value is assessed, and the correct tax is applied. And again, it's paid on iTax. So if you go on iTax, on the payment tab, you can generate a payslip for stamp duty. Because stamp duty applies on very many other things, like transfer of shares, the land, even on leases. So you sort of have to know even what to choose on iTax for you to pay stamp duty. So it's as straightforward as that. And then the deadline for payment of stamp duty is usually 30 days after valuation. So if you attempt to generate a stamp duty payment slip, there's a place where it requires you to put the date of valuation. So for people who get the property valued today and they will pay stamp duty in January next year, you will easily get a penalty for late payment of stamp duty. So stamp duty, the law requires that it's payable within 30 days from the date of assessment by the government valuer on the value.
I think that's very important, because when we, like in our previous projects, before sectional titles, when you were doing leases, you'd find you've done a lease for an investor, you're taking it for registration, but this person has not paid stamp duty. So the valuer comes and values their unit, and then they take a very, very long time for for them to actually pay up their stamp duty so that they can have their leases completely done. Another disadvantage of that is value can increase, because then again it's real estate, so value can really go up. So this 4% can move from 4% of 2 million for those who've bought studios in Skywalk and be 4% of 2.5 million. Easily, you know, so. very easily. So maybe just to mention why it is important for you to actually complete your title process and on time, when the cost is manageable. It's something you actually paid for to buy for the unit, to buy the unit. I think that's really eye opening. Anything else you'd like to tell us?
Okay. Yeah, so that's a very simplistic administration of stamp duty. But stamp duty, of course, is a lot wider than that. It applies to leases. It applies to when you are transferring property or shares. And it's usually again on whatever has been valued versus whatever the transfer cost is. And maybe just to mention, what we can also cover this in future webinars. There are very many also practical ways to structure around stamp duty. So if you're doing for most of your clients, Tsavo, where someone is buying a unit, hardly is there any structuring opportunity, because you need a lease. Stamp duty has to be paid before the title is out, and stamp duty is based on the value. And the value is determined by a third party. That is not Tsavo, neither is it your advocate. And the rate is also determined. And it's very simplistic in terms of there are no deductions, so it's just whatever percentage based on where you are versus whatever has been assessed. But for people who are in active, say, business, like developers, like Tsavo, for instance, there are very many ways to structure around stamp duty, stamp duty, and that commonly applies to companies. So if you're going to buy land as siblings or as spouse or mother and child, father and child, then there are certain exemptions that are extended to such family company organizations. So family companies, for instance, if you're transferring land from your individual name to a family-owned company, stamp duty is not payable, and you have to apply for a stamp duty exemption to the Ministry of Lands or the collector of stamp duty, demonstrating how you qualify for that stamp duty exemption. If, say, you are a more sophisticated developer and you have various companies here and there, and all these companies are related, say, through common shareholding. If you're going to transfer land from company A, which is a subsidiary of company B, then there's a stamp duty exemption. If company A owns more than 90% of company B. So there are various tax-efficient ways to structure real estate around stamp duty and also capital gains tax, which applies to more sophisticated structures or people who carry out family business through companies. So if you fall in that category and maybe you're of interest, you can reach out to us, and we will work with you in that journey of just showing you, ways to optimize your tax payments by taking advantage of tax exemptions, and hopefully in future we can do this for as a webinar also.
I think thank you so much for doing this with us. Here at Tsavo, we usually say when you have the knowledge of whatever you're doing, then you become very good at it. Many people fall into traps with Gare. Yani, it's just abrupt. you find yourself in a fix, it's just because you did not know. It's just because you did not have the knowledge to know, okay, I'm a property owner in Kenya. What do I need to do? I think for us, that's the passion that we have for each and every one of you who's joined us here, and everyone who will watch us on the recorded version of this, so that you get the knowledge and you get the information, and this then in turn helps in your decisions and helps you not find yourself in fixes that you don't want to. So maybe you can tell us where we can get you. Maybe people would like to see counsel, people would like further advice. Maybe people are actually in fixes, you know, and they need to get out. Where can we find you?
Okay, thank you for that. And as we usually say, ignorance of the law is no defense. So in Kenya, you can't afford to say, I didn't know. It's totally not an excuse, and really, the law doesn't care that you didn't know. So it's not a defense before any court, either of the public opinion or a normal court, including KRA. So I work with the firm of Mark and Partners. Mark and Partners is based in Upper Hill, Casneb Towers, at the 8th floor of Casneb Towers. I'm available on phone for diaspora clients who can't come to Casneb 8th floor Towers. I think they can put up my number. They can put up my number.
They share the details on the chat.
I'm also available on email. My email address is wangoi@markadvocates.com. Wangoi with an O. Yes. So that's where you can reach me, and of course you will find a pool of other lawyers that maybe as investors you've interacted with who will be there to also help you. So don't stay back. There's a lot of resource that you can use here. I think in our next series we can cover CGT, which is also another property tax that's major in here, especially when you're trying to dispose of property. That and how can we do restructuring around CGT and exemptions, and then further discuss VAT as a property tax. So be sure to join us the next time you see the link. Invite your friends who you think would benefit from this. So thank you so much. Thank you to everyone who's joined us. Thank you for the comments. Thank you for most of you are saying it has been awesome, great conversation. We are happy that we've been able to educate you, to give you knowledge so that you can make better decisions. As we conclude, I would like to leave you with a video from our founder. Thank you.
My name is Leonard Mcharo. I am the founder of Savo. Together with my wife, we lead a wonderful team of highly dedicated people. My name is Leonard Mcharo. I am the founder of Savo. Together with my wife, we lead a wonderful team of highly dedicated people, most of them young. Now, I know today I should be really excited about us turning 7, but I think I'm a bit more pensive because 7 years gives you time to think through where we have come from, and has also given me a deeper understanding of the responsibility that we have from now going forward. Now, Savo started from almost a point of disappointment and disillusionment. I think turning 40 does that to you. I was running a fairly successful architectural company, but it got to a place where I felt we had the tools to do more to impact this country, but I was not sure what it was. And backed by a group of young people who believed that we could do it together, we could do it. We came, and for about 18 months, we relentlessly searched for what Savo could become. And after 18 months, we realized we got a purpose, and the purpose was to enable investors achieve financial independence through affordable, amazing apartments. Now that was a big deal. It didn't just come from the air. It came from many trials and a lot of failure. We kept trying different business models and we kept failing. But my wife and I had invested earlier, many years earlier. and we were earning rent, and we were financially independent. And one day somebody just said, you guys keep talking about your financial independence through, small residential units. Why don't we do the same for other Kenyans out there? And that was the light bulb, I think, that just sort of changed everything. And from then we have pushed, we have gotten to understand what financial independence means, what it means to us as a purpose, but more importantly, what it means to investors. We have seen people's lives change. We have seen people who were spending their money aimlessly. You earn a lot, you spend a lot, and hope that things will be okay. We have seen that mind shift begin to happen among many people. And we've really been blessed. The team started with about 7-8 people here. And now we are 80 in the office, and we have more than 1,000 on our sites and in our different projects. Now, 1,000 people who earn their daily bread from Savo. That for me is a big blessing on one hand, but also a big responsibility. These are 1,000 families we are answerable to. We started with no investor. Now we have more than 1,600 investors and growing. 1,600 investors and growing. And these are people who have worked hard, they have put their money, and they expect results. So for me, that's a big responsibility. So far, we have 1,350 residents. When Skywalk is occupied, maybe in the next month or two, we'll have more than almost 2,000 people living in our units. And these are huge milestones. But for me, and I believe for the rest of the team here at Savo, we are just getting started. Because it is in these 6 years, and if you look at 1,000 people working, 1,600 investors, 2,000 residents, this is close to 5,000 people who have put their money, their time, their talent in Savo. And now for the first time, the brand is beginning to be known out there. So for us, we are just getting started. The first 7 years was sort of a get to know yourself session. And now we are moving on to the next one. So all these people, with the 6 projects complete, 7 projects ongoing, people are getting to know about us. We are seeing the beginning of a new wave of Savo. And this new wave means we really have to commit to this purpose of financial independence. This new era of Savo means we have to commit more to quality. We have to commit more to delivery. We have to commit more to compliance. We have to commit more to the neighborhoods that we are in, because we are affecting neighborhoods in a big way. We have to commit more to youth, the young people who live in our places. We have to take care of their financial needs, their shelter needs, their spiritual needs, and we are doing significant things towards that. So for me, Savo over these 7 years has revealed that we have been called to do this work. We are being called to be disciplined because it's a big responsibility, taking care of the human beings who work here, the human beings who live here, and the human beings who put their money here. So as we start the next 7, my prayer is that our commitment to this purpose will be more than before, and to understand that what is lacking in the market really is not real estate. That's not what is lacking in the market. What is lacking in the market is integrity. What is lacking in the market is discipline, is financial discipline, is a discipline to the building industry, is a discipline in investment. That is what we want to do. And our core value number 1 is discipline. So the next 7 years for me is where the purpose of financial independence and relentless discipline is going to be the thing. So to our investors, thank you for being with us. We could not have done it. I could not have done it with the team that is at Savo. We could not have done it without the residents. And I pray that as we move on, we shall deliver the things that you need to enable you to become financially independent. Thank you very much.
first apartment in Nairobi has never been easier. It's simple. With zero deposit and 0% interest rate, you can pay as little as 30,000 per month for up to 5 years. Just divide the price by the number of months you want to pay. Visit www.savo.ke to learn more.